Let's talk about this market. I mean, there's that puzzle, right? The market's cheering, expecting these rate cuts, but the data from the average consumer is showing that they're worried about their finances and expect higher inflation. In your view here, I mean, who has the better read on the real economy right now, the optimistic trader or the worried consumer?
Well, I think it's the consumer. I mean, if you look at even upper middle class income, middle class, lower class income, they are really in a hurt right now. But these people that are in their 40s and 50s have children. They go to the grocery store, anything they buy for education, school, whatever, it's all going up a lot in price. And it has them stymied quite a bit. I've talked to quite a few families like that. And, their problem is that they don't know what to do about it. I mean, they can make ends meet, but it's getting tougher and tougher and tougher. And for the lower side, they're not getting there. And I think that's what basically Wall Street forgets. They're sort of sit in the ivory tower and they forget what happens on Main Street. But I think Main Street is really where you are right now.
Have the old rules of investing been broken? Do fundamentals even matter in a market so heavily driven by this passive investing, this autopilot buying, and then the expectation of the Fed rate cuts?
Well, I know people get to thinking about that, but a dollar is still a dollar. Mm-hmm. And if you get if you buy a dollar for 80 cents, that still makes sense. And if you pay $1.20 for a dollar, that doesn't make sense. That's sort of where you are in the markets today. And I guess where I would disagree with people on the bearish side is you can have a safety net of 35, 40% treasuries or whatever. That doesn't mean you're not participating, okay? Right. It just means you're particular about what you're doing and you're not going to go all in and basically put risk fully on when you know things are at extreme price levels. And I mean really, really extreme. So it's not necessarily, you're not making an absolute 100% call. I'm completely out or I'm completely in. I just think you have to pick and choose and know what you own.
Retail and institution money is obviously actively pulling out of this rally, even as the indexes hit new highs. I mean, does that divergence tell you, is the smart money selling to an algorithm-driven rally? What are your thoughts here?
Well, usually at a high, and I've been through a lot of highs, what happens is the late players, and a lot of times individuals, and I have to say individuals get bagged because they keep on buying into it and they can't see what's going on underneath. Mm-hmm. A lot of the selling that's going on right now, I know a lot of money managers and good ones. And then in this past 6 months, 9 months, a number of those have said, we've started to raise some cash now. And these are people that hardly ever have cash, but they're good at what they do. And I think individuals just keep right on going because they say, well, they're not going to let it go down. Fed's going to be there to protect us. And it works till it doesn't. And then you look back and you have to remember what Bob Farrell said years ago. Whatever you go extreme in one direction, you'll usually eventually correct extreme the other way. It may take a number of years, but that's what happens.
The last time we spoke, you said you were holding about 50%, a very significant position in cash. Holding that much cash, does it mean that you've missed out on this rally? I mean, for a client paying for performance, what are you thinking about sitting on the sidelines?
Well, Jeremy, it depends on what you own. I mean, I won't get into particulars. I can't do that. But I'd say our performance this year, really look at it this way. Just this is the way I would explain it. Mm-hmm. If we hold about 45% liquidity across the board now in treasuries. But let's just say the market's up 11 and let's say we're up 8. I'll use that as an example and these are not, but what I'm trying to say is if I'm earning 80% of what the market is earning with only 50% at risk, mm-hmm. See, that risk reward right there works. That means that you're actually doing really, really well because you're not out there on the full spectrum of risk. And I think that's what people forget to see. On the bond side, we just don't feel like you can ever you'll buy long-term bonds and you'll chase these yields in here. It's the wrong thing to do in our opinion. I mean, we think by this time next year, you're going to be right back to the Fed raising rates, chasing inflation down, trying to push that number. And it looks to us like you're not going to get you'll get a big bang out of this as far as the market. People will feel good, but that's the wrong thing to do, is to go out and buy 20 and 30-year paper right now.
When you look at a company today, knowing that this broad market is ignoring traditional valuations, what are the top or three specific metrics that you kind of focus on to decide if a business is good investment? I mean, can you walk us through your process a little bit? I think people have forgotten it.
Well, for us, there's 4 or 5 things, but one, I'll just start with a balance sheet. You want to make sure debt to equity is okay, because if a company is heavily laden in debt, then you have to be perfect on the buy or where they are in the cycle. So that's really important, that debt to equity. The second thing that you look at is you really do look hard at free cash flow and what these can, and for all your viewers out there in free cash flow, it's really what's left over after you've paid everything else, plus what you've had to reinvest capital expenditure wise to build new plant and equipment, et cetera. But you look at that because that's what gives them the ability to increase dividends, to buy back stock, pay down debt. No, that's all good stuff right there that you look at. And we try to go out about 5 years and estimate what we think these companies can earn, and then we discount it back with a sort of an inflation number that we'll put on it. For right now, it's about 3%, and then we'll try to buy it a little better than that. And we're just trying to buy it. We try to get it. We try to give ourselves as much buffer as we can against being wrong. People realize you need to realize what you have to do in money management is make sure that you don't lose a lot of money. Because that's where it's hard to catch up, and I always recommend that to people. Remember risk management. It's the most important thing.
You told me in May that you hold a lot of physical bullion. I mean, and you also said all the way through as a core currency hedge. I mean, is this record run the ultimate kind of indication of that long-term thesis? And where do you see it going from here, Ted?
Well, what I said then is what I always say is that we have 3 strategies. But in the conservative fixed income strategy, almost everything we own is less than 60-month maturity, okay? And if you're going to own that as a currency hedge, because we feel like long-term, the dollar will continue to decline. If you're going to own the fixed income, you have you've got to own some bullion, some gold bullion to offset it. And that's what will offset it. And it's a different time now. I know people want to think about it, but most of these major countries are lining up against us, not for us. Look at Russia, China, India, to an extent, some of the South American countries. And they're buying gold. They're not turning their dollars around and trying to buy back into the assets of this country, particularly treasuries. They want to own something. Like even a lot of them against their own currencies are doing that. So I think you have to own it as a hedge like that. We're in a different era, a different time when probably a lot of currencies. Look at the sterling, pound sterling. You look at the euro, yen. You can't have faith in a lot of these, including the dollar. And I think that's why more of them side by side they own the gold bullion. And that's what I think people have to keep in mind.
Yeah.